You know, for decades, the story of investing has always been the same, right? Be patient. Slow and steady wins the race. But what if that race has totally changed? What if the rules are being rewritten as we speak? Just think about that for a second. What if the single most important virtue for an investor isn't a virtue anymore? That's a really unsettling thought, and it's what we're going to dive into.
So this number you see, $32,864. That is the power of patience, right there. Imagine you took 10 grand, put it into a solid, maybe even kind of boring dividend fund, and then you just left it alone for a decade. You didn't panic, you didn't check it every day, you just let it do its thing. This is what you'd have. It's the classic reward for playing the long game.
Okay, but here's where things get interesting. Because while that patient money was quietly growing, something else was happening in the background. A totally new kind of investor was being built. One that, doesn't need to sleep. It doesn't get scared during a market crash or greedy during a rally. And it operates at a speed that is just, it's literally faster than we can think.
So, before we get into what's new, I think it's really important to appreciate why the old way worked so well for so long. Let's talk about the power of patience.
The whole strategy is called buy and hold. You've definitely heard of it. It's the gospel according to legends like Warren Buffett. In the philosophy, it's actually pretty simple. You're not just gambling on tickers flashing on a screen. No, you're buying a small piece of a real company. And the bet is that over the long haul, the economy will grow and good companies will just naturally become more valuable.
And look, there's a reason this has been the gold standard for generations. First, you've got the magic of compounding, right? That's where your money starts making money, and then that money starts making more money. It's like a snowball rolling downhill, but it only really works if you give it a long, long hill. It also forces you to be disciplined. It takes your own emotions out of the driver's seat so you're not panic selling at the bottom or getting caught up in some crazy bubble. Plus, because you're trading less, you save a ton on fees and taxes. It's just a really elegant, powerful system.
But here's the thing. The world has changed. The market today is nothing like it was 30 or even 10 years ago. You know those old pictures of traders yelling on the floor of the stock exchange? That's all gone. Now, it's just the silent, cold hum of server racks.
And this quote from Andrew Lo over MIT just nails it. He says, "Now it's an arms race." And he's right. It's not about one smart person's gut feeling versus another's anymore. It's about machine versus machine. A full-on computational war for tiny, tiny advantages that happen so fast, a human being can't even perceive them.
And this didn't happen overnight. It started pretty innocently. We just wanted computers to help us execute big trades more efficiently, to be our assistants. But then, the assistant got smarter and faster. And that's how we ended up with things like high-frequency trading, where the algorithms aren't just taking our orders anymore. They're making their own calls in literal microseconds, way faster than a human brain can even process.
And now, we're at the next step in that evolution. This is something beyond just following a simple set of pre-programmed rules. We're talking about systems that can actually learn, that can strategize, that, for all intents and purposes, can think for themselves.
Okay, let's try a metaphor here. Think of a traditional portfolio, your classic buy and hold strategy, like a paper map. You draw out your route before you start your trip, right? Maybe it's 60% stocks, 40% bonds, and you pretty much stick to that plan, maybe checking in once a year to rebalance and make sure you haven't drifted off course.
Now, an agentic portfolio, that's not a map. It's a self-driving car. It knows the destination to generate returns, but it is constantly scanning everything around it. It's watching the news, looking at economic data, sensing social media sentiment. It's rerouting around a market crash, like it's a traffic jam. It's speeding up, it's slowing down, all on its own, all in real time.
So what's the engine in this self-driving car? It's something called deep reinforcement learning. And here's the really mind-bending part. You don't give it a bunch of if this, then that rules. Instead, you basically lock the AI in a simulated market and you give it one goal: figure out how to win. And so it does. It plays the market millions and millions of times, learning from every single win and every single loss until it develops strategies that, they're strategies a human might never even dream up. It's designed to find an edge in complete chaos.
Okay, to make this really concrete, let's go back to that traditional fund we talked about. What you're looking at here is a snapshot of its sectors. You see a lot of energy, healthcare, consumer staples, all the classic stable stuff. It's a solid, human-designed plan. But the key word here is snapshot. It's a picture. It's static.
Now compare that static picture to this process. An AI agent doesn't do static. It's in constant motion.
is doing something called sector rotation. It's inhaling millions of data points, everything from official economic reports to the general vibe on social media, and it's trying to predict which part of the economy is about to take off. And when it thinks it knows, it moves the money. Instantly. We're not talking about rebalancing once a year. We're talking about adjustments made in days or even hours.
So what we have here is a genuine crossroads. These are two fundamentally different, almost opposing philosophies on how markets work and how we should be navigating them.
Let's just lay it all out side by side. The buy and hold approach, it's basically a bet on economic gravity. The core belief is that over the long term, the whole thing just goes up. But the Agent AI portfolio, its core belief is that the only thing that matters is speed and being able to predict the next move. The time horizons are completely different. One is thinking about your retirement in decades, the other is thinking about next week. And look at our role in all this. In the old model, our job is to be disciplined, to stay the course. In the new model, our job is to build the machine and then get out of its way.
And this isn't just some, nerdy tech debate. This is a fundamental challenge to everything we thought we knew about the nature of investing.
I mean, listen to this quote from the former CEO of NASDAQ. He says, "The trading that existed down the centuries has died." He doesn't say is dying, he says it has died. He's not making a prediction about the future, he's telling us what the present already is. The game has already been changed, whether we've realized it or not.
So that leaves us with a really tough question, doesn't it? For our parents' and grandparents' generations, patience was the ultimate shield against market chaos. It was the one true virtue. But now, in a world where machines are being built specifically to predict the very next move, is our greatest virtue now our greatest risk? Is being patient just another way of saying you're too slow? I really don't have the answer, but I'm curious what you think.